Hi, everyone. Pleasure to be here, at least virtually. My name is Todd Gartner, and I am the Director of Natural Infrastructure and the Cities for Forests Initiative at the World Resources Institute. It's my pleasure to address y'all today and talk about conservation finance, how we find the sources of funds for green and gray infrastructure to protect our rivers and watersheds. And for me, rivers and watersheds is a form of community. It's where I recreate. It's where I get the greatest joy, whether I'm on a 3-week paddle trip down the Colorado River through the Grand, or in my own backyard in the Columbia River Gorge on the lower section of the white salmon. It's just such an incredible asset across the West. And what I hope to cover over the next 20 minutes is really some of the trends around conservation finance, the sources and sequencing of funds and finance, run through a couple of case studies where this has really been brought to bear and proven successful, and then we'll have a bit of a discussion session at the end. And as incredible as those river systems are that make up our West, as everyone on the line knows, there are some incredible challenges. Drought and floods, land use change, fires, climate change, and all of these things are piling on top of each other while we have growing populations. And the way that we've been thinking about addressing these problems over the last several decades needs to change. And for it to change, we've got to change the way that we invest in our natural systems and the way that we think about funding and financing. And what I'd like to do is just start off by giving a quick rundown of the various sources of funds and financing that are out there. These aren't kind of linear one after another all of the time, but they do generally come in this sequence. And depending on what sector you might be in, I suspect most on the line are quite familiar with philanthropic and public dollars. These are most often oriented to get projects off the ground, do your due diligence and feasibility analysis. They may be coming from corporate social responsibility pools of dollars, local or national governments, and foundations. And that will continue to be an anchor in the conservation sector, in the rivers and watershed space for the foreseeable future. But we need to now think about how we leverage that with these new forms of capital. And in the foundation space, one thing that you're starting to see is movement away purely from just grants to think about what's called a program-related investment. So these are investments with a repayment structure, but generally much less than a market rate investment. So as I'll talk about in one of my upcoming examples, the Forest Resilience Bond, a foundation like the Gordon and Betty Moore Foundation or Rockefeller Foundation providing a 1% loan or a repayable grant. The next sort of pool of dollars is where you often hear this idea of innovative finance and private capital. It's green bonds, pay for performance, resilience bonds, beneficiary pays principles, putting surcharges on your water bill. And that's really where I'm going to focus most of the time today. All of this, the end game is to make this the new normal. To have green right there alongside the gray, and that institutional investors have this as part of their normal investment portfolio. So it's no longer just about impact, it's just plain and simple investing. And everyone on the line is a believer, I suspect, in that natural systems are a key part of our water security and livelihood agenda. If we all know that, and these projects have been talked about for quite some time, why have we not seen this get to the scale that we would all have hoped at this point? And there's a couple of reasons. One is many of these projects are not quote unquote investment ready. They're not of the right size. They don't have a particular return profile to investors, and those developing them maybe just haven't had that experience in that space. So, don't have the know-how, the financial literacy to really get it to that level. And that's what we're trying to change here. It's coming along, but the proof, right, that if you invest in watersheds, what is the quantifiable benefits that you will achieve in terms of volumetric benefits, sediment, nutrient control, flood control. We're getting better, but success will continue to breed success. It's a generational thing as well, right? It is at the universities, right? Getting this idea of natural infrastructure built into the curriculum. And as this idea of incorporating green and gray becomes more common, I think you're going to see even more experimentation, which will eventually get us to scale. And of course, we need to think about the benefits being recognized by all. People of color in lower income areas, rural and urban. For durable outcomes, we need to think about that cross-section of benefits. What I didn't mention is capital as a limiting factor. And if you work for a smaller nonprofit, you may be always fundraising as part of my part of my job as well. But there is a lot of capital, what we call sitting on the sidelines, looking to be deployed. There's been tons of surveys out there that investors have money earmarked for green stuff, and they're not finding projects that are what they would call bankable or investment ready. And this is being proven out. Major commitments, major accelerator type programs from big banks and federal governments saying, we are launching programs to invest in natural capital. Now we've got to do a better job of playing matchmaker and connecting these projects with the capital that is out there. So the demand is there, right? And now we're in a space of lowest interest rates in a very, very long time, 2% in many cases. So it's a great time to think about this new sources of funding and finance. And all of this is potential leverage and matching funds for what we anticipate being a meaningful stimulus with infrastructure as a focus. And most importantly, success breeds success. The more projects we can demonstrate hitting their priorities and goals and return profiles, the more likely we are to see replication and scaling. And I'm now going to work you through a couple of these successes. And I mentioned before the idea of innovation, right? You hear that a lot, innovative capital, innovative finance. And it takes both innovation, but let's not ignore the boring, right? Financial markets like consistency, certainty, and sometimes the metric of success is if it's boring, then you've done your job because it's then part of the structure moving forward. And what's more boring than debt, right? So the first example I'm going to give is about green bonds, which is a form of debt. And most utilities pay for their infrastructure with bonding, a form of debt. And green bonds operate in much the same way as a traditional vanilla bond. Only the proceeds, right, the money that you are getting from the lender, the proceeds are oriented for low carbon and environmental outcome. And in order to get a green bond, to get a certified green bond, there is criteria and a scorecard that you work with a third party to make sure that the use of the proceeds does hit the mark in terms of that low carbon and green profile. There's some follow-up and validation, but usually it's a quite reasonable cost, which many people think might be a barrier. But if you're issuing, a $30, $50 million green bond, $20,000 verification fee, we've heard time and again will pay for itself. And I'll talk about that as well. This idea of green bonds has really been taking off over the last, 5-8 years. But just recently, it's crossed the $1 trillion mark, and we've started to see it in the water space. And this is both the gray side, so low carbon gray water infrastructure, and the green side, watersheds, things of that nature, urban stormwater green infrastructure. And the goal of the green bond is to make sure that these water outcomes are as real as possible. Think about it at the catchment level. Think about the use of the proceeds relative to alternatives so that the GHGs are neutral or even lower than alternatives. And really importantly, thinks about how the infrastructure will hold up in the face of climate uncertainty. resiliency and adaptation, ecologically and socially. You've seen a lot of experimentation in Europe, and now we're starting to see green bonds for natural infrastructure in the US. Beautiful photo of the watershed for Little Rock, Arkansas. It is operated by Central Arkansas Water, a beautiful watershed that is under threat. Over a third of the watershed is industrially managed. There is land use change happening, and Central Arkansas Water wants to understand how they can utilize innovative finance to protect and restore their watershed. So the World Resources Institute, along with Encourage Capital and some of the funders you see at the bottom there, helped Little Rock and Central Arkansas issue the first ever green bond for forest protection and restoration by a water utility. So water quality was one of the primary desired outputs. It was over a $30 million issuance. A third of that went to forest protection and enhanced management. 2/3 went to traditional low carbon built infrastructure, fixing pipes, things like that, which in the aggregate will reduce energy consumption. There was a diversified base of investors that bid on the bond, and Morgan Stanley ended up paying a premium at just over 2% for the bond. So quite successful. Basically what this means, just like a mortgage, right? They're able to take the money from Morgan Stanley now, do their protection priorities, and then pay it back at 2%, just over 2% over a longer period of time. And that payback is happening through a number of different revenue sources. One, they have a rate surcharge specifically for watershed protection on their water bill that they're able to gradually increase every few years. They're looking at carbon credits and, of course, sustainable timber management with practices that are really strong for water quality. And so why are they doing this? And why are others thinking about green bonds in the water space? Well, as I mentioned, you diversify the investor base. A premium can be realized in many cases, enhance communication, raising the profile, and really showing that you are doing the right thing for your constituents and the planet. When Central Arkansas Water issued this bond, they got coverage locally, nationally, globally, from right and left-leaning periodicals, in the finance space, in the environment space. And so, again, $20,000, some staff time, but it more than paid for itself. The executive director of Central Arkansas Water, along with the finance manager at San Francisco Public Utilities, up on the main stage at global platforms talking about what they're doing. The mayors had an opportunity to talk about this. So it has definitely served as a communication tool and raised the profile of their utility. And we're starting to see a number of other utilities looking to replicate and contextualize for their own needs. What I'd like to do now is a slight shift from exciting but boring, the traditional bond financing, to something slightly more innovative. It's the Forest Resilience Bond that WRI has developed with the lead developer, Blue Forest Conservation. And it's there to address arguably the biggest environmental issue across the West, fire. No matter where you are, you're feeling it. I live west of the Cascades in Oregon, and for a week and a half, I had an air purifier running nonstop, and my dogs and I were stuck inside. And when you think about the level of infrastructure and human well-being at risk from catastrophic wildfire risk, it's scary, and it's only going to get worse. And there's many reasons, right? Climate change, the drought, more people in natural systems, so the likelihood of fire starting is increasing. But we do know that our forest conditions are a big part of it, right? If we look at how things have changed over the last 100 years, it is quite dramatic. We also know, though there's no silver bullet, forest restoration, forest health treatments are a valuable tool to reduce that catastrophic wildfire risk and therefore reduce the risk to our infrastructure and our water systems. The Forest Resilience Bond does have some similarities to a traditional bond in that investors are involved in the front end. They provide the upfront money to basically a middleman who serves to work with both the lenders and those who are going to be paying back. Once the money is received from the investors, it goes to an implementation partner, the men and women on the ground with the chainsaws, with the other equipment, providing forest health treatments on the ground. Once that work is done, obviously the benefits are provided, the risks are reduced, and beneficiaries like water and hydroelectric utilities, state agencies, then pay back the investors through the middleman. And I'd like to work you through a quick example to show you what that looks like in practice. The Yuba project, which we launched in late 2018, North Yuba River Watershed in the Tahoe National Forest. It's a 150,000 acre watershed. We focused on 10%, so about 15,000 acres where we did restoration across that area, just over a $4 million project. And we had two types of investors giving money up front, market rate investors who were getting 4% return per annum. And then, as I mentioned before, those program related investments. So those are our concessionary investments, a 1% per annum return. And so how this works is those investors on the left side, at least the way I'm looking at it, Rockefeller and Moore, 1% investment, Calvert Impact and AAA Insurance, 4%. Each one of them gave $1 million. It goes to the special purpose vehicle, which is the Forest Resilience Bond. The Forest Resilience Bond then gives that money in a scheduled approach to the National Forest Foundation, who hires the contractors to go in and do forest thinning, meadow restoration, aspen restoration, a riparian enhancement, and the like. Once that work is done, the investors get paid back. The Yuba Water Agency, which is a water supply company, a hydroelectric facility, they provided part of the repayment. The state of California, through a number of the water and climate bonding authorities and grant programs, paid back, in the Forest Service through planning and oversight provided in-kind contributions. And real benefits are being realized. So we're in year 2 of implementation at this point, and some of the numbers that you see on the screen are what help make the case to the utility and to the state and really to the investors that this was a return on investment proposition, right? Nearly $9 million of expected return just in this 15,000 acre area in terms of energy and water benefits, as well as benefits to the local economy. It's a pilot, but our goal is to move, so the first project was 15,000 acres. We're hoping by the end of 2021 to launch the second project in the same watershed for double the size. So at least 30,000 acres, and we expect that to be somewhere in a $12 to $18 million project. A number of other projects in California, as well as in Oregon and Washington, potentially Arizona and Utah. All of these are starting to take shape, and because of the scale of the problem, we need a solution that scales, and private finance, again, no silver bullets, but it will help us get there bigger, better, faster. One of the really important things which will help you diversify your investor base and your beneficiary base, those who are paying investors back, is being able to quantify the benefits, being able to tie them to whatever priorities that entity may have, to the sustainable development goals. And what we often do, not often, what we do with both the green bonds and the Forest Resilience Bond is come out with an annual impact report. This is the work that was done, the acres, the communities benefited, you know, as quantifiable as possible, what the benefits were on greenhouse gases, nutrients, volumetric water, and of course that means detailed monitoring. And in all of these cases, we are triangulating satellite imagery, looking at on the ground gauges, even thinking about how there's community monitoring in science. All of these things to collect data, to adapt our projects to be as beneficial as possible, and to have more successful proof points so that we can see this replicated and contextualized in other places across the country and really across the world. So with that, I know that was a lot, and for many of you, this may be a somewhat new concept. Don't worry. I'm happy to have conversations with any and all of you in more detail about how we did this, what we did, and most importantly, what it might mean for your watershed. So I look forward to the discussion section, and thank you so much.